Well, good afternoon, everybody, and thank you for joining us today. I'm Debra Brennan Tagg, and I am the president of BFS Advisory Group. And we really appreciate you taking some time to join us for Conversations with Smart People. We started the series last week, and we are continuing it this week with Phil Blancato. So last week, we talked about business owners and how to build teams. This week, we are talking about investment portfolios, and we'll be talking about the risks and opportunities that are out there in the world. We have had a wonderful time investing over the last 12 to 18 months, but we definitely have some new headwinds on the horizon. And one of the things that we just wrote about in our most recent market report is that the financial news is the news these days. Everybody is talking about inflation and interest rates and the supply chain. And so what we are all talking about in our offices is what everybody seems to be talking about in the world. And so we wanted Phil to join us today so that he can help all of you to understand some of the things that we talk about as colleagues. Phil is part of Advisor Group, and Advisor Group is the broker-dealer that we are associated with. BFS Advisory Group is a boutique wealth management firm right here in Dallas, and we provide investment management and financial planning. We have this association with Advisor Group so that we can be a boutique firm, but have a very large arm behind us that allows us to have access to all the kinds of investments that we need in order to work with our families the right way. Many of you are already clients. Some of you are new to our firm. So you probably already know that we do lead with financial planning. We have 2 CFPs here on staff, and we also have a CFA, and she's in charge of all of the research and the trading on the portfolio side. We lead with financial planning. We view the investment portfolio as an extremely important piece of executing that financial plan. And we really take a holistic look at everything that we do for our clients, whether it's investment management, tax management, estate planning, philanthropy, insurance. We do all of those pieces as part of our client's financial plan. And we know that lots and lots of people have questions about what things are going to look like going into 2022. So I'll ask Phil to go ahead and join me now. Phil has over a 30-year history in investment management. And he is the president of Ladenburg Thalmann Asset Management, and he is also the chief market strategist for Advisor Group. I've gotten to know Phil over the last couple of years, and he and I were just having a great conversation before we started about education, about finances in the United States and how things are going out in the markets. We'll probably tap into some of that today. We're going to have Phil start us off and go through a background, kind of an overview of where things are on the economy and in the financial markets, and then we'll dive into some questions that I have. We certainly want to answer your questions. So if you have questions, you can send them to us in the Q&A or put it in the chat. If you need any clarification on any terms that Phil uses or that I use, please feel free to put that in the chat as well. We want to make this an open conversation and one that certainly serves you and answers any questions that you have. Phil, I'll go ahead and turn it over to you.
Thank you. Thank you for having me and welcome everybody. You know, there's a lot to talk about, and I'm excited to be here with you all. I've not met many of you before, and as Debra mentioned, I've been doing this for a while. It's just about 32 years. So what I found along the way is the one thing that's really fun about what I get to do for a living every day as a money manager / economist is that whenever we study the markets, sometimes history is a great guide. We tend to stay away from that term of, hey, this is different this time, because usually it's not. But certainly when we think about where we are in the world, it feels a little bit different. However, let's talk a little bit about the 70s. Maybe we'll go back to wearing bell bottoms again. Let's talk a little bit about,
Thank you. I said, no, thank you on the bell bottoms.
My daughter's still wearing them. My daughter's wearing them. I can't believe I saw them the other day. Because I think about inflation when it ran very hot the last time was probably the late 70s. There's been pockets here and there, but certainly this feels like it with some of the numbers from today. And I can talk about some of them that sound very frightening, and to a degree they are. When we think about where this all began, though, let's start there. Let's go back to simple economics, finance 101. When we were all back in college or high school even, there's 3 types of recessions. There's a typical cyclical recession. Things just get tired, they slow down. There's an event-driven recession like we just had, which is really rare. A direct event caused the recession, which was, the other time that happened was World War II. And then there's structural, like we had with the 2008 financial crisis. What makes it an event-driven recession, for someone like me, as a student of the markets, it's fascinating. Now, obviously, the human toll that COVID caused is horrific, and we're still not out of it. But for the last, call it almost 2 years now, we're intertwining economics, and Debra made a great point. Financial news is the news today. We had to intertwine economics and COVID and what was happening together. And an eventual recession is interesting because it's the most passion of them all. I mean, a very abrupt sell-off is what happens, and then usually a very abrupt recovery, which is what we had. 2020 was far and away the most fascinating markets year of my career. And when I look back on it, it comes back to rule number one: never get emotional about your money. Far and away the biggest mistake investment folks make, even myself, is we get our emotions tied up in what's happening, and we sometimes forget about the simple math behind it. Well, let's look about where we were to where we are. First off, we've seen some horrific numbers last year, numbers that we never thought we'd see in our lifetime. US GDP contracted by over $4 to $5 trillion. Well, guess what? We've now filled in that hole that all that we lost. We haven't completely not only filled it in, but made up for what we lost. We've done a fairly good job at not just making it up, but getting back to where we want to be. And that's important because for us as the global economy, for us as the one that sets global policy on interest rates, for who is the default currency, you still want to lead the way economically. By the way, to tie that into your everyday life, often we talk about the 10-year US Treasury and yield on the bond market. The reason why yields haven't skyrocketed higher here as US government's printed a bunch of money is because we're still number one in the world, which means we're still number one economy in the world, which means if you're out there and you want to buy a bond from a country, where would you rather buy your bond from? Germany, where if you buy a 10-year bond, you get 0.07 per year. With the average rate of inflation in Europe today right about 4%, that means you lose 4% every single year. Or would you rather buy an American bond, yielding the 10-year Treasury yielding today 1.5%? Now, albeit based on today's inflationary math, you're still losing about 8.5% per day, and I'll explain that in a minute. But certainly, it's better than making nothing. My point is, some of the craziness of the data is what I'd love to talk to you all about today. So let's leave last year aside for a moment, that we had this wild sell-off and this wild recovery. Where does that put us now? Well, first off, let's assume you run a company and you run company ABC in the first quarter of 2021. Let's make it up that you made $10 in revenue. Believe it or not, by the second quarter of 2021, you made $20 in revenue. Now wrap your head around that for a minute. You were able to increase the gross revenue company by more than a double. Well, here we are in the third quarter, and we're about to add actually another 40% increase in revenue. And by the fourth quarter, probably another 30% increase. What's that mean? Well, the stock market has run very high, and it's trading at valuations that are kind of sort of hard to understand. And it's happened to a degree based on the federal government printing lots of money. You see, what the federal government did to get us through the pandemic clearly was, rather than let us fall into a deep recession and then work our way out of it, create a bridge from one side of the pandemic to when the pandemic becomes endemic. And that was done by printing to the better part of almost, depending how you look at it, $4 to $10 trillion. And I'm going to show you a slide on that in just a minute. But the reason why they did that was to create a safety net. But on the other side of that safety net is this euphoria of all the money they put into the marketplace. And it comes into the tune that whether you're on a corporate company and you're borrowing money, you're able to borrow it at the lowest yields ever. Whether you're buying a home, housing prices right now are up to the highest level they've ever been, with the average price of a used home in the United States closing on $430,000. That number pre-pandemic in 2019 was $380,000. You're looking at increases anywhere from 20 to 50%, depending on where you are in the country, on average 18. So what you see is a real unusual kind of imbalances in the system because of what the federal government did. But give the federal government some credit here. They did get us to the other side and kept us from having maybe a very deep and long recession, perhaps a depression. So I will be on the side of the camp where I would applaud what they've done up until now. And what's happening now is really quite fascinating. As the money came back into the marketplace, as we began to recover, the stock market has roared because of it. Low interest rates mean stocks should be higher. We're able to borrow cheaper and folks have money to invest. It's not the best place to be in the bond market, and we'll get to that in a minute, but certainly it's boosted the stock market. But eventually all good things come to an end. And right now, clearly we're at this sort of ebb tide of data. We had really terrible low tide last year. We had really incredible high tide this year. That some of those earnings numbers I just mentioned. And now what's happening, we're having a transition. And that transition means we're slowly going back to normal. What does normal mean? Well, before we get to normal, we've got to deal with this really incredible numbers of inflation that are out there. But the Federal Reserve is recognizing that normal is coming. So just a few days ago, the biggest announcement of recent days here was that the federal government has decided to slow down the printing press. And they're going to do that by, to kind of wrap your head around this a bit, the US Treasury needs money or prints money. The Federal Reserve wants to infuse that money in the system. So basically what they do is the federal government at the Federal Reserve buys bonds from the US Treasury. And they've been doing that to the tune of $150 billion a month. Every time they buy a bond here, they take that money and they put it into the banking system. So instead of buying $120 billion a month, instead of buying $120 billion a month, they're going to finally start to slow it down. They're going to buy 10 billion less of treasuries and 5 billion less of mortgages. By June of next year, on the path that they're on, they're going to begin to completely be out of the bond buying business. That means the buyer of last resort in the bond market, the one that's kept an artificial lid on interest rates, keeping rates low so we can go get a mortgage real cheap or borrow money or whatever the case may be, will be out of the way. So naturally, interest rates should rise because the biggest buyer is gone. Now, to my point earlier, there are other places in the world that want to buy our bonds because our bond market's more healthy. Doesn't mean that rates won't go higher, though, because there's still lots of bonds we need to print because we've got $23 trillion in debt and bonds come due all the time. I want to talk to you later about the impact of rising rates on discretionary spending, but we'll get to that maybe in Q&A with Debra and what that means. But more importantly, what's happening now is the party's beginning to end. And that's why you saw some volatility in the month of September. That's why you're seeing this euphoric rise in October, November is normal. It's somewhat cyclical. We see this time of year, but it means over the prolonged period of time, as the federal government gets out of the way, it means things go back to normal. It means we don't get 25% returns on the stock market. We probably don't get, exceptional returns on the bond market. We probably actually lose some money on bonds for a while. Normal. So today I want to talk to you a little bit about getting back to normal. And that's, for example, our expectations for next year is that GDP growth in the United States for the fourth quarter of 2022 will be somewhere around 6%. By the fourth quarter of 2022, it could be back to 2%. So that tells us as we go down, things have to change. It means working with Debra, I'm sure they're going to change the way they manage your portfolios, find different ways to navigate volatility. It's not just put money in the market and let it go higher, because we joke, the punch bowl's been spiked at the party by the federal government with lots of vodka. Well, when the punch bowl's gone, you have to have a good time without the vodka. And when the joke is that the federal government has been so accommodative in helping us stay afloat. When they're not there, what do we do differently? So my opening points today are the inflation that you see is really a byproduct of what the federal government did, partially, not completely. The supply chain issue is a real thing, and I'm going to show you some fun slides on that in just a second. But these things tend to be temporary, not all of them. When you look at the wage number today, I actually thought the wage number was quite fascinating in that the year-over-year number, which there's still a base effect, meaning we're still coming off these unusual data from 2020, but it is the month-over-month number that has me really quite spooked. When I look at the month-over-month number, believe it or not, the average rate of inflation at a 0.9% headline CPI means we have 10% annualized inflation if things stay the way they are today. And in fairness, I'm sure you're feeling this. I'm sure you're at the pump and you're paying as much as 40% more at the pump right now. I'm sure you're not happy that when you go to, if you went to buy a used car, it's up 42% year over year. If you go to buy meat or poultry, up over 10% year over year. TVs, hotels, 12 to 20% year over year, and on and on. So those things are real and they are painful, but they tend to be supply demand based. The whole world, the whole country is now doing more than they've done. We see retail spending up month over month. We're now spending as much as we did pre-pandemic. Well, here's an oddity that was created by the Federal Reserve and money we printed out and money you didn't spend. Guess what? The U.S. consumer is sitting on just about almost $3 trillion of cash. Believe it or not, it's the most amount of cash ever accumulated by the United States people that live here, our citizens, ever. We have the lowest amount of debt that we've ever had. I saw an interesting headline yesterday. My local news, I happen to be watching it with one of my kids, and The headline was, Americans have amassed more debt than they've ever had before. True statement. But that is only one piece of your asset picture. You've got to look at all your assets. If you have debt, well, what do you then have in cash? What is your house worth? What's your total net worth? Believe it or not, as a country today, we're worth over $150 trillion. So the average person today is sitting on cash they've not had before. Believe it or not, the savings rate in the United States right now, for every dollar you make, how much do you save? Is 7 cents. That number was 30 cents during the pandemic. You know what our average is going back to about 100 years? Only about 3 to 4 cents. So we're still saving double what we normally save. What does this mean? That we, the consumer, are in pretty darn good shape. The unemployment rate recently dropped to 4.6%. We have 10 million jobs open in the marketplace and only about 5 million people to fill them. We are short somewhere between 3 to 5 million people. We've got 3 million people left the labor force and they're not showing up. You're seeing average wages, part of the inflationary picture, which I think is permanent, go up significantly higher. We went through 3 decades of average wage increase below the rate of inflation. Well, for the last 4 years, but especially the last 2, wages are up on average 4 to 8%, depending on industry, with the average of this past inflationary print right about 5.5%. So what it means is the average worker is going to make from $8 an hour in some cases to as much as 15. That's permanent. You're not going to tell somebody to go back to making less money. I can see home prices correcting, come back down as interest rates go higher. Mortgage get more expensive, the housing price will come back to normal. As the world's oil producing nations decide to produce more oil, and that might take some time. This time they're acting a little differently than they did in the past. You would have seen oil get back to normal at some point. We're already seeing natural gas come back down to earth a little bit. Grains, yeah, there was a flood out there in China, and there was a flood out there in India. Both had very heavy rain seasons, so our grains are way up. That would get back to normal in a normalized crop cycle. Beef, there was an issue with some of the rendering plants. There's a little bit of politics here. The 4 major rendering plants are owned by 2 large conglomerates that decided to reduce the amount of supply to market to increase prices. Well, capitalism being what it is, there's a group of farmers, actually partially in Texas, that are getting together to create a 5th independent rendering plant. Interesting. Capitalism at play at its best. That won't take long to bring the plant online. Could be up online by next summer. Point being that something that will normalize. Cars should normalize. Sure, some of this stuff is painful. And I would suggest that inflation is going to go higher before it goes lower, because you've got, call it about $2.5 trillion that's going to be spent. Look at it this way. Going into this holiday season, we're going to spend almost $850 billion on the holiday season. The 2019 holiday season was just about $790 billion. We're going to up it by $60 billion. Halloween, believe it or not, guess how much Americans spent on Halloween? $11 billion. That's the most ever. So with people flush with cash and demand being high, you would expect inflation to stick around for a while, but not be permanent. And the reason why it's not permanent, there's 2 things that battle inflation that are not gone away and only going to get worse, or depending on how you look at it. One, demographics. We're an older country. And with the bulk of the nation's worth, 75% of it with people over the age of 65 and older, they don't have the same spending habits they did when they were, call it in their 30s, 40s, or 50s. So when the wealth of the country is with folks who spend less, especially after a pandemic, that means we're not going to get runaway spending forever, somewhat temporary. And then secondarily, that amazing thing called technology. Think about all the things you don't buy because of your phone. Think about the voice recorder, the video camera, maybe the computer, maybe the TV, all these things we don't buy. Technology, believe it or not, is deflationary. When you spend less money on things that you no longer need, well, you spend less money, but more importantly, efficiency. American productivity, believe it or not, is up 6% year over year. And yet we've got millions of people out of the workforce. Why? Well, because we're more productive with use of technology. In the long run, technology is deflationary, not inflationary. So those are forces that aren't going away. Just right now, they've been put aside because of all the money that's been pumped into the system. So my opening salvo, things are pretty good. The economy in the United States is growing. The pandemic is becoming endemic slowly. In fact, let's talk about that for a minute. Every pandemic ever has always become endemic at some point. Viruses mutate away, and we build a resistance to them. Even HIV to this day is at this point endemic. So when you think about this one, certainly the Delta variant was a curveball. But at this point, and trust me, we have spent endless hours studying the virus because it matters economically. You're in an interesting scenario. The average daily cases in the United States improving quite rapidly, leveling off at a higher number. In fairness, we're now leveling off at about 70,000 cases per day. We had gotten to where we had about 20,000 cases per day pre-Delta. And now with vaccination rates in the United States, with first shots being just about 66% for fully vaccinated, first shot, and about 58% for first shot, you're looking at, if you believe in natural antibodies, which depending on which body of research you look at, Israel versus Europe, so on, plus the fact that you're going to be vaccinated, the United States probably has an immunity right around 81%. Remember, there was projections that anything above 70 created a herd immunity for the country. And it's looking like we're there because over the last few weeks here, not only have we had a significant reduction in new cases, what I care more about is hospitalizations and fatalities. Hospitalizations are down 70% from the recent high, fatalities down nearly 80% from the recent high. Not back down to zero, and that'll be an interesting debate, what zero mean. But with vaccines now being available for every cohort, and that's up to you whether you want to, whether or not children should get vaccinated or not. Truth be told, when you look at the data, children under the age of 18 today represent 1,000 fatalities of the 600,000, of the 700,000 that we have. You could debate that, I understand that, but regardless of that fact, if you're trying to get to herd immunity, vaccines do play a role in it. An interesting study out of Harvard and an independent research firm studying 180,000 adolescents, 90,000 vaccinated, 90 not vaccinated. The 90,000 that were vaccinated had a 92% reduction in symptoms or infection versus those unvaccinated. The vaccines. So in that sense, as the globe gets vaccinated, and projections suggest that by September of 2022, 70% of the globe will be vaccinated, and that by March of 2022, 80% of the United States will be vaccinated. We're well on a course to have the pandemic become endemic. Interesting point about people getting vaccinated. What I like to take a close look at younger folks because that's squarely in the headlines these days. Believe it or not, kids between 12 and 18 today are now 55 to 60% vaccinated already. People over the age of 65 are 99% vaccinated to as low as 95% first, second shot. So those who are most susceptible are vaccinated. Those who haven't been vaccinated are getting vaccinated. The average weekly increase is still about 3% increase in vaccinations per week. And just for fun, there now have 6 states that are over 70% currently vaccinated, doubly vaccinated, which means you have 6 states that are above herd immunity, at least what we would expect them to be. Point being, I don't think that we will have another issue with Delta bringing the economic down into contraction. But notice, Delta variant clearly did that. We had expectations of the third quarter of the United States having a 6% GDP growth and something to the tune of 50 to 60% earnings growth. While we're still going to get great earnings growth at about 40%, GDP growth for the third quarter contracted all the way to 2%. I live in New Jersey. I work in New York. We are still very much under a mask mandate. I can't go in and out of my building without a mask. My kids go to school in masks all day long. Restaurants are limited in capacity, size. Most establishments won't let you in without a mask. That is a contraction. Goofy example. My daughter plays on a high school soccer team. They were in the state semifinals. 5 kids on the team got the vaccine. They canceled the game and forfeited. Same thing for the football team. Those are 2 events that didn't happen. Now, in a micro moment here, the cars that were going to drive to the field didn't drive. That gas wasn't used. The spending that was going to happen at the concession stand didn't happen. The referees that were going to referee that game didn't get paid. Now take that and extrapolate that to the whole Eastern Seaboard from, call it, North Carolina up. It's an impact, and that's why the country contracted in the third quarter because squarely of Delta. So while we're not out of this yet, we're in better shape here in the United States. But one thing that we note, there still are very much hotspots in the world. Singapore is a country that fought back and basically was not going to let anyone who was infected with the virus in their country. Well, guess what? The virus found a way in, and now they have runaway cases in Singapore. On a numbers basis, it's not a lot, but on a percentage basis, it's the highest far and away they've ever been. Japan better, but still battling it. Vietnam, still not out of the woods yet. Malaysia still dealing with cases. Turkey, across the board, there are hotspots around the world, whether it's due to limited vaccinations or the approach of trying to limit people coming in with the vaccine. The zero case mentality just didn't work. New Zealand right now going through a significant outbreak. And those affect the supply chain. So COVID is not over. As much as we'd like to believe it's over, it's certainly not over globally. It's better for certain. You saw the United States open up travel yesterday. By the way, global tourism represents 27% of global GDP. There's $1 billion that's generated a year in hotel airline receipts between London and New York alone for air travel. It is a massive thing when the globe can't travel. And turning that back on is critical to the recovery for the globe. And finally, yesterday, what to me would be a first step in that direction. But certainly, we are not out of the woods yet. And at a time when it's critical to continue to analyze it, something like the Pfizer drug that just came out, I'm not sure if you saw that, Pfizer has a pill. Really interesting when you look at this data. It could be the most significant moment in the battle against COVID in months, because their pill for two times a day for 4 days will bring down, listen to this, those who are most susceptible to disease, heart disease, obesity, kidney disease, lung disease, by over 90%. Now, they only tested it on 750 people, so that random size is a bit small. But of those people who were infected and could potentially become fatalities or hospitalized, more than 90% didn't get sick. If this is as good as it's being marketed as, this thing is over quicker than we would have thought. It is a game changer. Even the Merck drug, to a lesser degree, is only 50% efficacy, but something to focus on as we think about where we are in COVID. It is something we need to continue to monitor. So that's a long opening salvo, Debra. Sorry, I'm rambling. But I want to show you a couple of quick slides. I don't want to go on forever here. I really wanted this to be about questions and have a chance to talk to you about markets. I mean, look, we're up again 25% on the S&P this year. I'm sure for those of you as old as me, I'm 54. You know this isn't normal. You know you don't get multiple years in a row of gangbuster markets. Eventually, like a grandfather clock, the pendulum swung so far to the left in 2020, being terribly negative. Now it's swung so far to the right in 2020, being incredibly positive. Going back to the middle is an important part about it. But I do want to show you a couple of fun slides. Give me 1 second here. That I think will give you help us reiterate some of the points. Okay. I hopefully you can see my slides. Can you see those, Debra?
Yep.
I'm going to expand my screen so it's a little prettier. Okay. All right, just a couple quick things, just to help reiterate. I will skip this. So I talked to you a little bit earlier about the changing of the forecast of growth of revenue. Look at 2021, where we thought we were going to be from growth and what the consensus originally was. But notice for both of the years, look at these returns over here. You're looking at Q4 being a 6% GDP growth. Look all the way to the right. Look at 2021, 2022, 2023, 2024. There's your return to normalcy. Going from a 6% growth rate all the way down to just about 2%. Where were we before all this began? Just about 2%. Why? Aging demographics, technology, and reality is us and the rest of the globe are in a very unique time frame. For the next 15 or so years, the demographic impact of post-World War II will be a profound drag on the entire globe. For example, China. We often talk about China dominating the world. Doubt it's going to happen. I just can't see the scenario. Why? They have 1 billion people. They're going to reach the age of 60 about the same time in about 4 to 5 years. That impact is profound because then it affects their inability to manage their workforce, to create, to manufacture. It's singularly why they're converting from a manufacturing economy to a service economy, just like we did, because they're changing of the guard of their population demographic. Because remember, they had the one child left behind. They eliminated it. You can have as many kids as you want now because they have a demographic issue. What country's best representative of this? Japan. They're shrinking as a country. They don't have enough bodies to support their economic wealth. And for that reason, they're the most indebted country on the planet. Per dollar they make, they owe 2. So forecasts like this are critical, and they play into what your expectations might be for markets after this euphoria of what the Federal Reserve did and the recovery from the pandemic did for the equity market and to a degree the bond market. I put this in because I thought it was fun. I took this picture. So I happen to have a client in California and not far from the port of LA. The supply chain is an interesting one. These are all cargo ships that represent the imbalance out there in California. Now, it's more profound in California, more stuff comes to California.
Mhm.
But the reality is what's a little unfair is, believe it or not, ports are operating above capacity. It's
Mhm.
just that our demand is so great that we need more truckers, more routes filled, probably 100,000 routes undelivered, 30,000 more truck drivers needed, and probably more people at the ports. Interesting, yesterday, the Biden administration is going to repurpose $215 million to help build temporary pop-up ports, add the ports that are there, and then use money to either bring more people in or do whatever they can to relieve this problem. Applause for that. I think it's helpful. And over in the new infrastructure bill, excuse me, 17 billion will go to enhancing port technology. But this isn't so much that people don't want to go back to work. I think that's an unfair narrative. It's much more about we needed a lot of stuff and it's coming in. And the rest of the world, China, Vietnam, so on, have had COVID issues, but at times they've been able to produce a lot, and times they haven't. It's all ended up on our shores. There's some gouging in here. Why did a container ship go from $1,000 to go from one shore to another to $20,000? How did ships go from being oversupplied to severely undersupplied? Why are we seeing price imbalances in multiple places when I don't clearly understand why the meats market has to suffer the same ills when we're back full steam on our plants? Some of it is let's not let a good catastrophe go to, or a good crisis go to waste. But in the reality, there are moments like this out there on the West Coast. What this means for you all, higher prices. And that's why today's inflation number was a real number. We look at something called PCE, personal consumption expenditures. CPI is interesting because there's one measure that includes food and energy, one that does not. I tend to look at the one that does not. Energy is up 5% month over month. Listen, the oil countries are not dumb here. Making $80 a barrel means they're going to be making $40 to $50 a barrel. Why let it go back down? Why overproduce when you don't have to? As long as demand stays high, they're going to make money. Venezuela is making money for the first time in probably 20 years. So there's something to be said for this, is why the oil cartels, including the US, are being careful to not overproduce this time. And my point is, all this means higher costs. When I strip out food and energy, you're still looking at annual inflation costs right about 7%. So there are real cost issues in there, whether it's cars or homes or so on. And it's because of some of these tight imbalances on just the goods you buy. Have you noticed how much more you're paying when you go to a restaurant right now? In some cases, more than double. I bought a bottle of wine at a dinner with a client last night, and the bottle I normally buy was more than double what I paid a year ago. I was bored. Now it's Italian wine, so it's got to be imported. Same thing.
Right.
I'm an Italian guy, so all I drink is Italian wine. So I can't help. Couple other quick things. I often get asked about how much money did we actually spend. So what you see here is money that we've actually spent so far due to the pandemic. 4.6 trillion with a chance to be 6 trillion in legislative actions. That's clearly stimulus. And then 3.6 trillion at the Federal Reserve. Now, to not bore you with the details, because this could get a little technical, the Federal Reserve has bought $3.6 trillion worth of bonds. We could actually get rid of that piece. If the Federal Reserve is willing to commit to stop buying new bonds, which they are, and then let those bonds mature, just like a CD in your bank, then we go down to spending about 4.6 to $5 trillion on due to the virus. Not nearly as bad as the potential to be $10 trillion if we continue at this pace. I think some sanity has come back into this, and there's a reason why I say that. And this is important. We should talk about this as a group. I want to make this clear. I often get comments about the debt. Do we have too much debt? We do. We have a lot, but not nearly as much as the rest of the world. For every dollar we make, we owe $1.05. What could be very problematic is today the average interest payment on our debt is 1.5%. So we own $23 trillion at 1.5%. Our interest payments per year are about $600 billion. Why we've got to be very careful with interest rates is what happens if interest rates push significantly higher and double from here. The average return on a 10-year Treasury going back for years is 4%. So what if we go from 1.5, we're to say to 4%? Well, that means that the interest payments on our debt could double or even triple. Well, what does that mean? So instead of spending $600 billion a year in interest payments, it might go to 1.2 trillion. It might go to 2 trillion. Have you ever taken a look at what the budget looks like for the federal government? Well, if you take out defense, Medicare, Medicaid, Social Security, guess how much is left for discretionary spending? Only about $2 trillion. Well, if you spend all that money on interest payments, now you look like Japan and Europe to other countries where the bulk of your money is spent on interest payments and social programs rather than growing. reason why we've held on to the pole position as being the largest country in the world with the default currency and the ability to manipulate global economies and interest rates is because we've always had excess capital to spend on Silicon Valley, to spend on space programs, and so on, which is real. The private sector and the public sector meet to create new opportunities, no different than what's happening in the electric vehicle space. So in that sense, it would be very problematic if our debt becomes so expensive that we can't spend anything else. That's the only thing that keeps me up at night, not the size of the debt. It's our ability to control it. And the Federal Reserve taking the first steps finally to slowing down the size of the debt and reining in interest rates potentially is a positive sign. We may not love it, what it does to the stock market, because it eventually can hurt it. And we're certainly not going to love what the bond market, the way bond markets work. As interest rates go higher, prices go lower. That's why we're down in bonds this year, not up. So that's just how things work. And it's probably going to be that way for a while. Listen, if you're as old as I am, you spent 30 years making money in bonds from 1982 to now.
Mhm.
We might have to lose money for 4 or 5 years in bonds before we can make money. Maybe not lose, be flat to down marginally.
Mhm.
Everything comes back to normal at some point, and that's the process we're in now. Just a few other quick slides I thought would be fun. I'll skip this one. We talked about it. That's okay. There's our forecast. The savings forecast for the end of the year. Look at that number, 8.5 to 10.5% increase year over year, $850 billion we spent, the biggest number ever. That should be great for the stock market and help justify a little bit about the euphoria that we've seen in October and November. Is inflation transitory? We talked a little bit about this. What you see here is CPI and PCE. Look at this kind of really incredible chart pattern where we went from very nominal inflationary rates forever. PCE is really what it costs you to buy stuff. Look at that explosion. So I wanted you to see it graphically. It's real. Inflation is real and it's here. My thought is though, things come back to normal eventually. Everything's transitory. Maybe not in 1 day or 1 month or 1 year, but eventually comes back to normal. We'll get back to that chart pattern before that steep increase. It's just going to take us some time to get there. I would say no more than a year, maybe a year and a half if things really don't get untwisted in the bottlenecks of the supply chain. But eventually, demographics and technology and normal supply chains will win out. I'll skip that one just a point of fun. When you think about the number of jobs we need, so look at right here, professional services and business services right now. The number of jobs we have right there, we need are 1.8 million. But yet we only have 900,000 people looking for a job in that place. So think about that. The average company can't find people. I work with an advisory group. They to hire 20 people recently, they sent out nearly 1,000 resumes. I mean, that's kind of mind-boggling. It's very difficult. The leisure and hospitality industry is an interesting one. See, that one's gotten pretty tight, 1.7 versus 1.5. We've added back 2.5 million people in that industry. We're 85% below where we were pre-pandemic, but there's still a gap. So I'll tie this back to a hot issue, immigration. I'm a very pro-immigration guy. My mom and dad are from Italy. I'm a first-generation American. If you can decide legally or illegally, I'll let you all figure that out. But you need bodies. You need probably the upwards of 300,000 to 400,000 people per year to satisfy our need in the job market. As 10,000 people retire every day, some people have left the job market because of COVID and don't want to come back. Maybe want a different job and don't have the right skill set. Filling the skills gap will be a whole new paradigm for corporations. Self-learning inside the corporation, remote learning for new employees, teaching new skills because they didn't come in, they don't have the skill set now because they need to put a body in that position. Whole new industry being created around what the Zoom economy did. And it's because we need bodies. It's a critical step for us. We are still the only developed country in the world with positive demographics. Last year was our first year ever that we shrank. We got to get away from that. You need to grow as a population to sustain your economy. If you don't, we look like Europe, Japan, Russia, and eventually China. Countries that are contracting, not growing. All right. Finally, this is an important part because this one, I want to explain this. I'll just make this quick. When the stock market runs at these really high rates, notice that first bullet point there. The current PE ratio on the S&P 500 is 25. It's a 31% premium. Since I wrote this slide, it's come in a bit. This is really important. It's a little technical, but I want you to understand. When we look at what we buy companies, we look at the current price in the market versus how much they earn. We call that the price to earnings ratio. Not a big deal. It's just pure numbers. That average on the history of the S&P 500 is 19. The current number is 25. So squarely, that means stocks are not inexpensive. It means their price is higher than how much they earn. It's an imbalance. So for that specifically, what we have to look at, we need earnings, the E part of it, to catch up to the P part of it, which is why where I started, the growth of earnings in the second quarter, that 100% growth, and the 40% in the third quarter, we would ideally love to see that continue for another 6 quarters, 4 quarters, even 2 quarters, but it doesn't look like we're going to get it, which is why the stock market is not inexpensive, not overly expensive, but not inexpensive either. So in the world where there really is no other alternative to stocks, because the bond market, believe it or not, is even more expensive because of interest rates going higher, prices go lower, we have to be very mindful of what we buy for you in the stock market. You got to be careful keeping it high quality. Be aware that markets just don't go up all the time. Volatility is going to be more of a common thing in the months and years to come. So just a quick look ahead. First of all, bull markets in and of themselves eventually come to an end. 20% up on the stock market are wonderful, but they don't really happen. This is one of the longest periods of time ever that we haven't had a correction of 5%. We normally get 3 every year. We usually get one of 10% every 15 months, and usually one of 15% about every 18 months. We just haven't had that since we're going way back into the pandemic. So certainly you're looking at a period of time when we're due for one. However, October was a 6% month, the best October ever. The fourth quarter of the year is the best quarter of the year with an average rate of return of around 6%. And then go more fun than that, November and December combined have an average rate of return of around almost 4%. Well, we've already got a lot of that. It's already up quite a bit so far for the fourth quarter. But with the Federal Reserve being very good about telling people what they're going to do, with earnings hanging on there and this euphoric spending, we should have a really nice run for the rest of the quarter. I would think we could add another percent or two to the S&P 500. Today's inflationary scare is spooking the market a bit. I think that'll be somewhat temporary. Well, let's see how the next few days play out here. And then we'll get into a good solid finishing the year off around here, maybe a bit higher. So using history as a guide, always coming back to that, November, December are good months. September's a tough month, just like it was this year. And more importantly, as we get through some of these bottlenecks in the supply chain, we should be in much better place to rein in inflation and then fix some of the labor shortages. We're seeing this past month's unemployment number was a great improvement, adding over almost 600,000 jobs, people coming back to work. I think that the data suggests that we are in pretty good shape. So we covered a lot. I know, Debra, you may have a few questions. Why don't I stop there and see if I can answer some of your questions, or if I can get into maybe some questions from the folks who are listening in.
Yeah, I have a quick question for you. So, one of the things that you and I have talked about a little bit is the future of investing. And you did a fabulous job of talking about all of these different things that are affecting the financial markets all at one time. And so, part of what we talk about in our market report, we do a quarterly market report. It's called Risks and Opportunities for a reason, because every quarter the risks change a little bit, the opportunities change a little bit. And right now what seems to be happening with so many of our world things going out into the headlines is that people will read, oh my gosh, supply chain. Oh my gosh, inflation. Oh my gosh, interest rates. And there's a lot right now that sounds like there are headwinds to the financial markets, both the stock and the bond market. And so some of our clients are saying, oh, we heard X, Y, and Z is going to happen. We're really worried that the stock market's going to go down a whole bunch next year. You and I both know that those things, A, don't happen as dramatically as the headlines tell us, B, will return to normal like you're talking about, and C, don't happen in a vacuum. So that there are things, I have great faith, and I know that you do too, in the capacity of U.S. businesses to overcome different issues. So interest rates go up, taxes go up, whatever it is, they're still going to go out and win. They still want to go win. They still want to create profits. They still want to grow the shareholder value and so on. But you and I have talked about in kind of this new normal that we might be getting into, the traditional 60% stock, 40% bond split may not be the way to go if, in fact, some of these demographic things come to fruition without counterbalancing issues, or if the inflation does get entrenched. So the whole thing is it transitory, or is it actually going to get entrenched into our economy? So those are things that we need to take a look at. And there might be other opportunities as opposed to, especially the U.S. large cap growth, which has been such a big winner for so long. We've seen a really nice transition to small and mid cap this year, to value, also to international, where there's some good opportunities. What are your thoughts going forward? I mean, I think you and I, I've been doing this for over 20 years. You've been doing it for over 30 years. I feel like people like us kind of walk into these scenarios thinking, okay, well, here we go. It's time for us to roll up our sleeves and sharpen our senses and figure out where we can invest for our clients and still achieve results. What are your thoughts about the changes that are happening and how many of them might be temporary and how many of them might be something where we really need to start thinking about different ways to invest kind of in the 3 to 5 year time frame?
Great question. Well, first off, inflation in and of itself is generally a good thing for the economy, early stage inflation, because everything inflates. The wages inflate, growth inflates, stock or company corporate earnings inflate, and so on. That's the normal course. This one's a little bit different in that it's not the normal course path we've been on, but I think early stage inflation is good for stocks. Where it's bad is bonds. So, we grew up in a world where we had this free lunch in fixed income, where you got 5-6% return on your bonds over a period of time because you just earned your income. You didn't care if the price went up or down, you just earned your money. And truth be told, as interest rates went down, prices went higher. So you won both on the appreciation of your bond, but you also won on the income that you earned. Well, in a world where that's over, assuming we get to normal again, and let's assume normal means 2% inflation, which means the 10-year Treasury should trade somewhere 2% plus a premium. And that premium is going to be based on economic growth, assuming that the GDP of the United States is somewhere around 2%. It would mean the 10-year Treasury simple math should trade around 3.5 to 4. So in that environment, simple math again, if I've got a portfolio of bonds that are 10 years on average and interest rates move by 1% higher, I just lost 10%. That's how the price works with bonds. So that means we have to do things differently. On the other side of interest rates going higher, might start to look like the mid-90s again, where a normal portfolio where you could earn 3%, 4% on your bonds and have an average equity portfolio and value stocks beating growth in a normalized environment. But until that point, we've got to do a lot different. So one, it means we're going to have to take more risk in the portfolio to get you some earnings. And we're going to do that by using fixed income as an insurance policy. Maybe we don't hold 40, maybe we hold 30 or 25% in the average balance account. And then we use 10 or 15% for alternative investments, things that'll earn income, hopefully act differently than the stock market. We'll hedge out risk of the market, maybe using options. We have strategies today where inside of a bundled mutual fund, we use option strategies that can limit risk. Or we use things like high yield, more risk, but we can be paid to wait around. Perhaps things that are inflation adjusted or inflation protected to a degree, real estate, knowing that real estate is generally a pretty good payer with some volatility. So it means that the traditional model portfolio that we grew up with of a 50% stocks or 50% bonds isn't going to look like that anymore. So we're going to have to find ways to add value through dividends and alternative sources of investment, because the bond market could act as insurance if things went down in the economy. But assuming we get a normal grind higher, it's going to be a kind of a drag on the portfolio. So it is quite different. And the reality is we're going to be more active too. It means we're going to have to be more aware of changing market conditions. This environment is going to be quite fluid. What happens with the next election cycle? And I notice I don't talk a lot about politics. I'm apolitical. I don't care about politics. I need to make you all money based on what Washington does. But if the next election cycle goes to where the House and Senate get split, that means no more big government spending. This infrastructure bill is going to add $250 billion a year for the next 10 years to our debt, assuming there's no taxes. If there is, that's a different narrative. But it's a big spending bill, adding off 900,000 jobs and spending in a lot of areas that the market's like that. So if that doesn't happen, that's another situation that's out of the marketplace, means we again need to find ways to navigate a very unusual market, one that we haven't seen since probably 1978 to 1982. So that's a very different time. And I think more so than be very aware of the pulse of the economy, changing conditions. By the way, this is in 1978 again, 1979, with inflation running to 10, 12% per annum and interest rates on bonds going 15, 18%. That's not the case. We do not have an energy crisis globally or domestic. We do not have ultra powerful unions forcing wages up by 15, 20%, that consistent. We have a diversified workforce today where 51% of people are now consultants and not working for a direct corporation anymore. They're independent contractors. It's a very different economic company than we are today. So runaway inflation seems unlikely, especially when it is a supply chain issue. But it does mean that you and I, and managing money, are going to do things very differently. And that's where we're going to have to be transparent and honest about how the approach that we take and being challenged by markets that are going to be unique.
Well, and a follow-on question to that, and it kind of pulls together some of the questions that we're having in the Q&A right now. We don't do a whole lot of sector investing here. We believe in more diversified approaches. One of the sectors that we do call out is healthcare. And so we believe that that's a long-term demographic trend. So that's not something that we pull in and out like other advisors might use a sector play just for a certain period of time. It's a long-term hold for us, but it is our only pure sector play that we have. Some of the questions that we're getting are about the infrastructure bill that just got passed. So if it's put into process and everything, are there some investing opportunities there? Also electric vehicles, and then thinking about oil. We're of course based in Texas, and so we always care about oil, whether it's doing well or whether it's not doing well. But are there some opportunities in investing there? Oil's taken such a crazy ride over the last year. I mean, who would have thought that it could have shifted in price as much as it has over the short time period? But do you see any investing opportunities there to complement some of the more traditional stock and bond stuff, or how are you approaching sectors?
For sure. First of all, I think there is an opportunity, and I'll start with emerging markets. I'll pivot from you a little bit. I do think offshore, we haven't made money offshore in years. Europe has a long catch up to go to the United States. So international developed and emerging markets are both squarely areas I'm interested in, specifically the Asian Pacific Rim. As 1 billion people become consumers and not manufacturers, playing off the Chinese consumer, I think will be an opportunity. I think we can add some real return without a lot of money there. And then even Europe, in the catch-up trade, there might be a chance that we can do well there next year as well. Two things, it depends on the dollar. The dollar more than likely is going to stay strong because we survived this pandemic and are still quite strong. As the Fed gets out of the way, the dollar should strengthen even more. By the way, the strength of the dollar doesn't have a profound impact on equity markets. There's times when a strong dollar meant bad markets, times when strong dollar meant good markets. It's much more about corporate earnings. We do have 40% of offshore earnings, 40% of S&P earnings come from offshore. So there's a little bit of an impact there. But then you make up for foreign demand or less demand based on the strength of the dollar. So if the dollar weakens, which I don't expect that to happen, I do think you can have an opportunity offshore. But even in spite of that, in the catch-up trade, there's something to be said. I don't like oil. I think the oil trade is the most difficult trade you could possibly be in, simply because there's so many things that affect it. It's geopolitics, it's domestic politics, it's global demand, it's domestic demand, it's green energy versus not. So it's very challenging to be successful in management oil. But I do think that for the client, the person who can handle volatility, the pipeline industry is fascinating. We are still 400 to 600 billion underserved in the pipes that we have today. Again, some politics in there. But assuming we need some of these to meet the energy demand that we're going to have here, and just for exports, and even existing pipelines, if you can buy some of those that are not going to deliver a big fat K1, and you can willing to deal with some of the volatility, you can get a nice big dividend, 8, 9, 10% on some of those MLP pipelines. Interesting asset class. But you touched on two I really like. For building a portfolio and looking for alternative assets. Now, these aren't going to zig or zag with the equity market or bond market. They're going to be highly correlated to the equity market. But the biotech space to me is a fascinating one. I think it's one that you could add a little bit of equity to and see real outsized returns with what's happened with messenger RNA and the future of biotechs. To me, that is a revolution that is happening right now, and participating in that, whether it's individual companies, which is much harder, but in ETS for those who want to take that risk on, I think it's quite fascinating. But then in the new economy, the gig economy, the one space that I'm highly intrigued with, it's not the cloud computing, it's not and there's opportunities there. I'm not saying it's not the snowflakes of the world, but I do think in the EV space, when you're looking at 65% of cars domestically, maybe even globally, being EV based by 2035, maybe even sooner than that, there's going to be this euphoria in that space. And I think you could take a little bit of money and try and have a long-term hold that could add real value to the portfolio. When you see Rivian today come out and be bigger than GM on the first day's trade, they've made 100,000 cars. So not even close to that. They're going to do to make 100,000 cars. You know, it tells you that there is this expectation that we're going to drive differently soon. And I think that that's an opportunity. It doesn't mean you're going to win by those, though. It means those are nice. They're icing on the cake. The cake is going to have to be a diversified equity portfolio where you take risk in small cap and mid cap, as you suggested. You're absolutely right. Where you take some risk in those lower asset classes, which generally bring more risk and more return. But for your audience, for your clients, you all have to understand that this last, since 2009 forward, has been an asset appreciation by the federal government. Call it what it is. The federal government has stepped in and pumped up the U.S. economy and made billionaires and millionaires of many, many people, not just the ultra wealthy, because asset appreciation has happened. Probably just wildly because we hadn't had it for 13 years. Remember, we had a lost decade from 2001 to 2013. We didn't make money on NASDAQ for 13 years, 12 years. So this was it had gotten too inexpensive, and the prices now rose. Well, now we're expensive again. So what does that mean? Sideways for a while. And sideways mean, I know you're a good portfolio manager. I know you all have a great team there. It is finding ways to navigate sideways means be paid to wait around, choose some interesting niche asset classes, take some more risk, and we're all going to have to accept some volatility. And you're going to have years where, believe it or not, the stock market has had down years. I know that may sound hard to believe, but there are years where it's down. 10%.
I don't know that investors remember that.
I don't think we all have short memories on bad stuff. It's how we're built. But certainly that's very plausible. And by the way, we've had multiple years where you made money in bonds and in stock. They're supposed to have an inverse relationship. They're not supposed to do that. 2018, you made 10% in bonds and 20% in stock. 30% in stock. 2019, forgive me. So, that's not normal. Pay for that.
They are supposed to diversify against each other. Exactly. They're not supposed to work together all the time.
In the year or two to come, no one can see that far out. But eventually you pay for the cost of where you've been.
And we have just a couple minutes left, and I want to be respectful of your time and the audience's time. You and I have talked a couple of times about how, and we're just talking before we got on about how this kind of some of the weird dynamics in the stock market and some of these outsized returns have actually caught the attention of some younger investors and are creating a little more energy and excitement around the stock market that, quite frankly, we haven't seen in a long time. So there might be some good results from things, even where we have some outsized returns where you think, how on earth can that keep going? That's probably not good for the stock market. There's probably some really good things that are going to come down the road from that. And like you're saying, the return to normalization will be welcome. One of the issues that we get a lot of questions about, and I don't know that anybody has any idea about, but you're great on data. We're always just fascinated by all the data that you study. Do you have any idea when the supply and the demand chain supply chain and the consumer demand are going to start to match up again? Because what it seems like right now is consumer demand is all over the place, and the supply chain is just trying to meet demand. And that's where we're having so many mismatches right now, and the ships in the harbor, like you were talking about earlier. Do you have any inkling from the data that you're studying about, like, okay, we can probably start to see it normalize in 6 months, 12 months, 18 months?
Yeah, for sure. We look at individual countries and where they are from the ability to be their supply chain really fully turned back on. And then couple that in with the risk of Delta and what Delta might do there. And unfortunately, because the Asian Pacific Rim is still battling through that, you're looking at the risk in China is still quite elevated, excuse me. And you're looking at that supply chain risk go all through next year. So the biggest manufacturer in the world will continue to have supply chain challenges through next year into the fourth quarter because of they've got to inoculate. Well, they are doing quite well in their inoculations, but nowhere near where they need to be from the size of their country. And to be quite honest with you, the Sinovac vaccine did not work against Delta. They have to come up with it. They've come up already with a new supplement, which means they're going to have to go back and vaccinate lots of folks. When you look at the other countries, everywhere else, Malaysia, Bangladesh, Jordan, Vietnam, South Korea, looks like they'll get their supply chains righted by second and third quarter. So that problem should resolve itself with all the goods that we need to bring back to us will come back online. For example, Tyler, Texas is building a chip plant, which will be the largest chip plant in the world, as I understand it, and should be online. I mean, full capacity 5 years from now, short-term capacity, they think 18 months, which I don't.
That's what Texas does. They just say, what are you doing? We'll just go do it bigger.
That's what you got. Look, Craftsman tools are made in Texas today. They used to be made in South Korea. So good for you all. You are your own, you're your own world down in Texas. 8th largest economy in the world. Good for you all. Point being, this imbalance is going to stick around for a while. And that's why I thought inflation will stay high through all of 2022. And more than likely, you don't realize a normalized environment until, sorry, folks, first quarter of 2023. You'll see it get better, but some of it's never going to get better. Let's not sugarcoat this. You're not going to see wages go back down. Never let a good crisis go to waste. How many companies are really going to cut their costs back down unless they're forced to? Now, you'd want to see more companies come online, but in the world of technology, we'll see how long that takes. So I would expect things to run hotter for longer. Access to goods should improve rapidly going into the second quarter of next year. and you'll start to see things level out. But the complete normalcy of on-demand supply chain, if we ever go back to that, I can't imagine we won't. By the way, it's too cost effective to be that way. Will take till first quarter 2023.
All right. Well, thank you so much, Phil. We really we always appreciate conversations with you and all the presentations that you do. We appreciate that you are apolitical. We appreciate that you're data driven. You focus on risk in your portfolios the same way that we do, and you always have great ideas, and you always challenge us to think about things in new and different ways. And so certainly the partnership is valuable to us, and everybody here at BFS Advisory Group is a big fan of what you do. And we just appreciate everything that you bring to us and to our clients. To all of you that have joined us, we also appreciate the time that you have spent with us, and we wish you a wonderful afternoon. Thank you so much.
Yeah.